This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Kia ora and welcome back to Money Made Simple, brought to you by Simplicity. Welcome back, Jenny.
Hi, Liv.
So I actually just wanted to start today with a little reminder to all our amazing listeners. Just a little favour, if you are able to, we'd love you to rate the podcast, whether it be good, bad or indifferent rating. It really helps us get the word out there more. Basically, we want to educate and help people grow their money in the long term, right?
Yeah, absolutely. So any kind of feedback will be useful.
Exactly.
Right?
There's like no such thing as bad PR. There probably is, but anyway.
I don't think that's true.
And even better, if you do love it, please hit subscribe. I know we've got quite a few of you that already do, but that really helps us get the word out.
Thank you to those of you that are subscribing.
Yes,
that's awesome.
Exactly.
Anyway, what's the topic today?
Okay, obviously, whether it be KiwiSaver, whether you're investing in property or funds, we know that investing can be a super powerful tool for growing your wealth and securing that better financial future, right? Yet fear of the unknown often holds people back. So use of jargon and complex sounding concepts can really kind of act as a barrier for many Kiwis to, I'll put it in inverted commas, get ahead financially. So we thought, well, there's a way that we can help, right?
Yeah. So we believe that with a little understanding and knowledge, everyone can learn how to invest and unlock potential for building wealth and achieving financial goals. I know that for me, definitely, if I hear a word that I don't understand, I might switch off to all of that information because I'm like, oh, I don't get that. I'm not, Yeah,
because knowledge is power, right?
Yeah, absolutely.
Okay, so let's go through terms we feel like every savvy investor should know and including some stuff that we've been asked about. We'll hopefully be able to explain each in a way that's just a little bit easier to understand and relate to. This might seem like a really obvious one to start with, but let's go super basic. What is an investment?
Well, I think that's a good question. Probably obvious, but not always completely understood. Mm-hmm. So an investment refers to the allocation of money
or other resources,
yes,
right?
Into what we refer to in our jargony financial world as assets. And assets can include shares, bonds, real estate, or even just money.
So like cash.
Yeah.
Our cash fund, for example.
Which seems like a weird thing, right? Investing into cash, because wouldn't that just be money in the bank? But anyway, so investments are usually designed with the goal of generating income or growth in the asset value over time.
So whether that be your shares or your cash or your property, that's the asset value.
Absolutely.
Yeah.
So people or businesses tend to make investments in order to grow their wealth or achieve specific financial objectives. For example, you might want to generate a passive income, so you've got a set amount of money and you want to live off the income that's generated.
Or you might be saving for retirement, like in the case of KiwiSaver.
Yes, or funding new pursuits, say business or moving overseas or whatever it is.
Yeah, you're basically wanting to grow your money, so you make investments.
Yeah, so I think there was actually two terms in there really, because there was what an investment is, and that is investing money or something into something else, into assets, and then assets. So, there are various assets like we said. So tick.
Awesome. So that's kind of investing 101 in a super quick nutshell, obviously. We mentioned shares, which can also be called stocks or equities. Why do they have so many names, right?
So many names for the same thing.
Yep. When you own a share, you essentially own a piece of a company. So if the company does well, so do your shares. If it doesn't, though, your share or stock or equity value may decrease. It's kind of like having a tiny slice of a big corporate pie, right?
Pie. Exactly. Owning shares means that you get to share in the company's profits and growth over time, which can come through to you in the form of either increases in the value of your shares or via dividends.
But what the F is a dividend? That's probably another one that confuses people, right? Should we go over that?
Yeah, well, it's basically a share of the profits that's paid out to shareholders. But you're jumping ahead. We'll go over that in a minute, Liv. For now, just moving on to bonds, which is another asset.
Stick with the list.
Yes, another type of asset, but quite different to shares.
Yes, but they're very boring. Bonds are much more boring than dividends, right?
They sound quite boring.
I
used to have something called bonus bonds. They were quite exciting.
Okay, well let's go back to bonds in the
normal bonds.
Well,
okay, so when you buy a bond directly, like we do as a large scale investor, you're basically lending money to an entity.
Oh, posh word there.
I know, entity, like a government or corporation. The entity or the issuer of the bond who needed the lending, they promise to pay you back with interest over a set period. So that's what we call a fixed income investment.
Yes. So fixed income assets assets, also sometimes known as fixed interest. Again, another jargony term. They refer to ones that provide either a fixed or very predictable stream of income over a specified period. So they typically cover bonds, which you've just explained, term deposits, and then there's some other debt investments offered by companies or governments. Although this last one's probably less known, less common.
Yeah.
So bonds and other fixed income assets are generally considered less risky than stocks because with an individual bond, as you've explained, you'd expect to get your initial investment back plus your interest.
Yes.
So the interest is paid via what was predefined at the start, regular interest payments, and then the original investment is paid back at the end of what we call the bond term. Then within a fund like Simplicity and other investment managers who also offer these kind of funds, the interest payments on bonds are usually recycled into other investments. So that helps grow the fund. So, you've got a bond that's paying interest. We then use that to fund other bonds or other assets like we talked about before.
And then when the bonds reach their term, you then use that funding to buy more bonds.
Exactly. So the fund kind of just goes up and down in overall value made up by a whole lot of bonds and or other assets.
Yeah.
Anyway, so being lower risk, fixed income assets are generally less about growth and more about stability.
Yeah, exactly. And with the risk thing, this all feeds into one of my favourite concepts called the risk return principle, which we'll get onto soon.
Yes, let's just first move on to investment funds, so related to investments.
I feel like people need a pen and paper for this, eh? They're like writing down the terms as we go.
If they're interested enough, right?
Of course they are. So investment funds.
Yes, so we kind of mentioned above, but these are investments that pool money from many investors to purchase a broad range of shares or bonds or other stuff that you invest in. The fund is then managed by professionals who try to maximise returns within, of course, an agreed risk tolerance with caveats around stuff like ESG or other kind of filters for the investors.
Yeah, so I think that probably sounds a bit jargony in itself, right? So
it's really hard not to.
Yeah, I know.
Yeah.
You kind of use a word to describe another term and then you need to describe that word as well.
And
so basically, just think of it as a collective investment that diversifies your risk across various different assets. You don't have to pick individual stocks or bonds. The fund manager does all that work for you.
Well, you've just mentioned another super commonly used bit of jargon, haven't you? Diversification.
Oh, yes, I did.
Yes.
Good catch. Thanks, mate.
Welcome.
To be fair, we have covered diversification in quite a bit of detail back in episode
14.
Oh, good one.
Absolute
Yeah,
squash,
so there was a whole episode on that, but it is a super important part of investing. So let's just talk about it in a nutshell.
Yes.
Diversification is about not putting all your eggs into one basket.
Right.
So apply this to an investment strategy rather than investing in one or just a few or a concentrated group of assets in, say, a particular sector or something. You look to spread your investment dollars across a range of assets and asset types.
So like shares and bonds and property and all of that.
Yeah, so you're diversifying your risk across not just shares, but bonds, property, and other asset types.
Like we spoke about.
Yeah.
Okay, cool. And relevant to investment funds is a term that you'll often hear in the industry called asset allocation. So kind of, I know, sounds schmancy, but this is just about how you divide your investment assets among different categories. Like Jenny, you just mentioned shares, bonds, other types of investments that we haven't gone over in much detail, like property or crypto, whatever you're including. Asset allocation basically involves like a strategic approach to balance your risk and reward based on a whole range of things like your investment time frame, your risk tolerance, and the goals you have around your finances.
Yeah, absolutely. I was just thinking that quite a good way to think about asset allocation is going back to your pie, because obviously I've been thinking about pie since you mentioned it, is if you think of your investment as a pie, then your asset allocation is like how big a slice has been dedicated to property and how big is the slice for shares and how
much apple you like versus pastry.
Well, exactly. What does that pie look like? How is it kind of cut up
divided
and
up?
Made?
Yeah.
And that is going to help you balance that idea of returns versus investment risk.
Great segue into that risk return principle that we said we'd come back to. Can you explain to us what this basically means?
Yeah, well, the reason it's one of my favourites is because we go out and talk to lots of people about how they choose their fund type.
Very important one, right?
Yes, and what we're asking them to think about is how much risk they're willing to take in return for potentially higher returns. So the idea is that it's sort of a balancing act. The more risk you take, generally the higher growth. If you take less risk, then you're going to have that slow, steady growth.
Yes, and what does risk involve?
Well, So
more risk means
more volatility,
Yes.
basically. So a high risk fund might be a growth fund, for example, and they're going to have a higher allocation of shares.
Yeah.
And the market tends to go up and down. It's fluctuating all the time.
So that's what volatility means, right?
Yes.
Yeah.
Whereas if you had, say, a conservative fund and it had more of an allocation towards bonds or cash, that kind of thing.
Fixed income assets.
Yes. And you know that you're going to make a certain amount of money, but it will be likely to be less money over
You
time.
compromise your higher returns for that stability, right?
The risk and return principle is you working out what you're comfortable with.
How much risk you are okay to take on.
Yeah.
AKA the sleep test, right?
Yes, we talk about the sleep test. So if your investments are keeping you up at night because you're worrying more about the risk than the potential returns that you could make.
Like when the share market crashes, for example.
Yes.
Yeah.
Then if that really worries you because you can't see longer term
That will go up again. Yeah.
then you might be in the wrong fund.
Yeah. Okay, cool.
Hopefully that.
No, that I think that makes sense. I think we've covered the basics, which we tend to get coming from our members regularly. I wonder if we should do another of these episodes off the back of a call out for any further jargon that people want explained.
Yeah, that's a good idea.
Could be fun, right?
Yeah.
Anyway, for now, I think we were going to touch on just a couple more terms, which are super jargony, but kind of handy to understand.
Yeah, I think so. Well, we said we were going to come back to dividends.
Yes.
Which I
tried to cover earlier.
But it wasn't the right time.
False start.
These are basically payments made by a company to the shareholders, usually a distribution of profits. So when the company earns a profit, it can reinvest it in the business, or it can become part of a higher share price. So your shares are worth more. Or they can distribute that income to the shareholders as a dividend. So that is a payment that you will get certain times of the year.
Yes, and receiving dividends can actually be a legit way to generate income from your investments. So we talked about that passive income generation, right?
Absolutely. And it's important to note that KiwiSaver doesn't work like this. KiwiSaver, as the value of your investments grows, it just is reinvested into the fund. So
exactly.
No dividend.
Which then compounds your returns over time instead of taking some of your value out. And that's often what an investment fund manager, or like you said, KiwiSaver fund manager will do on your behalf. That's exactly what we do, rather than distributing profits or money out to investors, which actually involves higher costs and admin.
Yeah, and so that's Simplicity's approach to dividends within our funds. But there are other managers out there who do offer dividend payouts. Finally, let's briefly touch on an old favourite that I'm not even sure I completely understand.
No, it's a tricky one to
Hedging.
explain or understand for sure. We won't go into depth here as we don't really have the time, but very basically, hedging is a strategy that's used to manage risk that investments are held in foreign currency, i.e. international assets.
Which, when you're investing from New Zealand, you're going to have a lot of international assets, right?
And then there's risk that they fluctuate in value due to the changes in the exchange rate between the currency, that international currency, and the New Zealand dollar. Okay. So hedged investments use specific methods to basically lock in an exchange rate between the NZ dollar, in our case, and the holding currency of your international investment for some of the value, which would mean you're partially hedged, or all of the value, which would mean you're fully hedged.
Okay.
And this locking in of currency basically reduces or eliminates the impact of exchange rate fluctuations on the investment's value in its New Zealand dollars.
Okay. So I reckon that if we do another one on jargon, maybe we can do like hedging part 2, because I'm really interested to know like what are the pros and cons of hedging versus unhedging.
Yes.
I think we could do that.
Yeah, it can be super complex, but essentially hedging is around protecting your investments from differences in currency between your local dollar and the overseas investment, which actually can be a positive or a negative thing depending on how you approach and think.
Interesting.
Yes.
Okay.
Anyway, we're going to wrap up. So what have we covered?
We started with investments. What is an investment?
Yep.
Good place to start.
With the 101, the basics.
Yep. We covered shares, bonds, and other fixed income assets.
Yep. Talked about assets and the types and classes of assets.
Yep. We talked briefly about dividends.
Twice.
Early and at the end. Yep.
We obviously talked about how investment funds pool your investments with other investors, and
we had a little tangent off on diversification, just a reminder.
God, we covered a lot.
Yeah.
And then finally we covered a little taster of hedging at the end.
something to look forward to, learning more about hedging.
Yes.
Okay.
So hopefully this will help those who have kind of like maybe been turned off by all the jargon to gain just a little bit more confidence in understanding it all, taking the plunge, maybe doing a bit more of your own research into what investments might suit to help your future.
Yeah. And obviously we didn't cover all of the jargony words in the finance world.
Not at all.
Sorted.org, our fave, have a really comprehensive glossary that covers way more terms and concepts. And I also use Investopedia quite a bit too.
They're great for really simple definitions, right? Money Hub also has some guides that simplify concepts of investing. We always like to push people towards them.
Yeah, great. So there's some really good resources out there.
Yeah.
And as we always say, knowledge is power.
Absolutely.
Yeah. By taking a bit of time to understand these things, you can make more informed decisions about investing. You might already be investing, but can
you make it a little bit better?
Yeah.
Yeah. So, I mean, here at Simplicity, we basically try and make investing for the regular Joe
or Betty.
Yes. Yeah. Super simple by offering a range of investment funds that cover that risk spectrum that we talked about and hopefully suit different ages and stages and types of investors.
Yeah.
So it's worth checking out on our website if you do want to learn more, and always read the PDS, of course.
Product disclosure statement for anyone that doesn't know that piece of jargon.
Yep. And so what's coming up next time?
Well, I've got a guest coming in.
We love guests. Right?
Yes, for the next episode. Sam Bridgewater from the Pure Foods Co. is coming in to tell a super cool story about his company. It's a really innovative company that's tackling an issue around nutrition. Mm-hmm. And they are part of our private equity fund. So we invested in them, I think, about 18 months ago. And we've had Matt in recently who talked about our private equity strategy and how and why we do that. We thought it would be cool to get some of the companies that we're investing in.
And we can find out why, right?
Talk about why.
Awesome. Yeah. Sounds good. All right, well, tune in next time, and thanks for listening to this one.
Thanks, everyone.
Bye. Bye. This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds.